Hello, everyone. Thanks for tuning in. I am recording this because I know we had some technical difficulties for our first research and trade workshop today. I tried to use Twitch and it just didn't work. So we switched over to Zoom and not everyone got the memo, but I didn't want anyone to miss out. So I wanted to quickly kind of record everything I spoke about. It should be shorter than the actual workshop just because I don't have any Q&A at the end. However, if there is any questions on anything I've spoken about today or any questions that you have at all over investing and trading, feel free to email me at research@bowerfa.org. So without further ado, let's get started. So this is the virtual workshop number 1. What is investing and why do we do it? So first things first, everything I say here is for educational purposes. Investment strategies all come with risk, and that risk could include the loss of initial capital. So if you lose a bunch of money based off of things that we've discussed here today, you can't sue me for it, or the Finance Association. Please do all of your own research and make sure that you understand things that you're doing. And attendance or viewership past this point signifies agreement to the above risks. So first thing I really want to get into is what is investing? Now, this entire first workshop is really geared toward those who either have just started investing, opened an online brokerage account, or who are thinking of doing so. Now, when we think about investing, the dictionary definition is expend money with the expectation of achieving a profit or material result by putting it into financial plans, shares, or property, or by using it to develop a commercial venture or start a business. This simply means that you are sacrificing something now with the expectation of getting something greater in the future. In our world, investing is critical into having a kind of long life that you're able to enjoy throughout, especially after you stop working. It's something that these investments are most likely going to carry you through kind of the end years of your life. Now, there's always the chance that you get extremely lucky or are very good at something and just make a ton of money, and the fact that you invested may matter little because you made so much money throughout your working life. However, for the vast majority of us, that simply won't be the case. So we're going to focus on what is investing, why do we do it? So we know investing can mean a few different things. Really, it can be anything that, like I said before, you sacrifice now to gain something greater in the future. For the purposes of this course and the rest of these workshops, we're just going to focus on financial investing. So your stocks, bonds, ETFs, options. I will talk a little bit about futures at some point, although I don't know too much about that, so I won't spend too much time on it. But this excludes things like investing capital into private equity or investing capital into real estate or investing into rare artwork or wine. So those are things we won't talk about. We're just sticking to the financial side of things. Now that we have that kind of nailed down, I want to talk about investing and trading and the differences between the two and which one will work for you. So the first question is, investing and trading, are they the same? And the simple answer is they're not. A lot of people use them interchangeably, thinking that they're just synonymous with one another. I'm a trader. I'm an investor. When it's simply not true. Trading is much more short term. It seeks to capture profits quickly from the movement of a stock price. And this is typically done by using something called technical analysis, or trend trading is another good example. Simply going in with a short time horizon, meaning that if I'm a day trader, I wake up early in the morning, look at my news, figure out what trades I want to make or what stocks I want to watch, wait for the market to open, buy or sell a few securities, and then before the market close out all of my positions. Swing trading is very similar. The time span is from days to weeks, and then you can broaden that out even more to just trading, which is just going to be anything shorter than a year. Now, investing, on the other hand, is the opposite of this. It's a very long-term time horizon, a buy-to-hold mentality. So this typically means that when you're an investor, you say, hey, I'm an investor. You actually put money, do research into companies, and then put the money, your money that you believe in those companies to go further into the future. Um, Typically, you'll save for things like retirement, your first home purchase, just very long term. I mean, really, it means anything greater than a year is considered long term. However, when most people talk about it, it's 10, 20 years until retirement. For many of us in college right now, it could be 30 or 40 years until we retire. So investing for retirement is a critical one. Um, Another difference is trading doesn't necessarily care about the underlying fundamentals of a company or asset that they're investing into. They simply just want to trade short-term price movements. And they believe through their own methodology, typically, like I said before, technical analysis or trend trading, that they're able to do that effectively, predict price movements, and then make decisions based off of that again to capture those short-term profits. Whereas investing, again, a very long-term mentality, buy to hold mentality, cares about the companies that you're investing in. So, for instance, if I want to be an investor, I have some extra cash, I find a company that I shop at frequently, and I think to myself, wow, you know what? I see them constantly improving. I appreciate and I like their service, and then the product that they're selling me. So I'm going to look into their fundamentals, their financials, the things that they disclose to the SEC, to other investors and creditors, and see if, based on my analysis, again, fundamental analysis, that it is a good investment for me. And then if it is, I might put my money in there with the intent to leave it there for many years so it can grow. Investors typically will look for two types of growth, often both simultaneously. One is the appreciation of the stock price. So if a stock is trading at $10, they hope to see that stock price rise above $10. And for an example, to 15 would be a nice 50% profit right there. But additionally, they seek that dividend revenue from the shares that they have invested into. And a lot of the times they'll just reinvest that dividend revenue right back into that stock, typically called a DRIP program, but I won't spend any time on that. So investors get their income from two places, the appreciation of the stock price and then dividends. Now, another final thing I'm going to say about this slide when I talk about the difference between trading and investing is the risk-reward trade-off. So when you're trading, it's typically much higher risk. Your time horizon is very short, so time is not on your side. You typically will see much greater returns if you're a trader, if you choose a winner. Now, on the other side of that, you will also typically see much greater losses if you're a trader. And I will say, in my experience, and the experience that I've seen other people have, it is far more common to get losses whilst you're trading. Now, plenty of you will see stories or articles or whatever about people who engage in trading and make just tons of money, thousands of percent of return on their investment. Typically, trading options is how you do that. But anyway, it can be very appetizing to people who are just unfamiliar with how the stock market works and how capital markets work. And it can be alluring and it could lead you into a trap. So one of the things I'll talk about throughout the entire workshop series this semester is making sure you have, if you are going to trade, a trading plan. One thing I always err on the side of is caution. So I will almost always recommend to a new investor that they invest rather than trade to start with. Or if they do trade, they trade with something they're very comfortable with losing. And then likewise, investing seeks modest annual returns and tries to reinvest those dividends to acquire more shares. So lower risk, lower return. But we need to ask ourselves, seriously, investing or trading, which one's going to work for me? Which one should I partake in? So I have 4 questions here. There are many more that you should probably ask yourself. You'll probably know them, but these are the 4 basic ones that I think you need to make sure you consider. First one being, what's your time horizon? Time horizon meaning how long are you willing or wanting to put this money into the market before you can get it back? So a short time horizon, that's going to be days to weeks, maybe a month, with an intermediate term time horizon being months to a year. And then the long term is anything greater than a year. But again, typically when we talk about long term, we talk about um, 5, 10, 15, 20 years till retirement. So keep that in mind. Figure out when you actually want to receive your money back. So not only any gains you might acquire, but also the initial principal that you put into the market. So question 2, how much time do you want to spend managing your investments? Simply put, trading is going to take a lot more out of you than investing will. It's important in investing to do some due diligence and some analysis on the stocks that you're investing in. But once you invest in them, that's it. You own them and you plan on holding them probably for a long time. So, regardless of what the market's doing, you don't really care. Coronavirus, if you're not selling in the next 5 years or you don't need to retire in the next 5 years, you don't care. You might look at the market and observe the news, but you don't make buying or selling decisions based off of that news in a long term investment portfolio. Trading, on the other hand, you look for very specific news that might affect some stocks very, very much, and try to, again, capture money or capture profits off that price movement. So if you're trading, you're going to spend a lot of time looking at investments, good part of your day while the market's open, making sure everything is going in your favor. If you're an investor, you'll obviously do some initial work, and then as you get older, some rebalancing. But for the most part, it's significantly less than if you're a trader. Third question, what is your risk tolerance? So same kind of differentiation there. Low risk tolerance means you don't want to lose. I mean, no one wants to lose money, but you're less okay with losing money than someone who with a high risk tolerance would be. So again, this is sticking more toward the investment side of things. In more extreme cases, this means when you invest, you don't even invest into stocks, which carry significantly more risk than something like fixed income bonds. So again, you need to assess your own risk tolerance. If you have a portfolio of $10,000, you need to figure out what you're comfortable, what you can still sleep with losing. So if you decide, okay, what if I lost $500? So 5% of the portfolio. Would I be able to go to sleep at night and not toss and turn because I lost 5% of my portfolio? If the answer is yeah, I'd be able to sleep okay, that's within your risk tolerance. If you decide, oh my God, $500? No, 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 I can't do it. I couldn't lose it. Then that is too much risk for you to take, and you need to adjust your investments accordingly. And we'll talk more about how to adjust that kind of plan later. And then we come to question 4. What are my financial goals? So I have 2 examples here, new car and retirement. I think they're both good examples. The new car, for instance, let's say I want a new car in a year. And I only have a certain amount of money now to make that happen. I have a job, but I still pay bills and tuition and all that other cool stuff. So I'm going to go ahead and try to be aggressive with my money. I want to turn this $3,000 into $13,000 by next year. So I need to adjust my trading plan to take investments that might get me there. So a lot of risk, very short time horizon, a lot of time investment managing those trades. Or retirement. I want to retire in 40 years with $5 million. A lot of your finances class will have you go over this kind of stuff, so I won't spend too much time on it. But that's a much longer term objective that suits an investor. You'll put your money into places, large company stocks, large cap stocks, ETFs, index funds, mutual funds, stuff like that, and just let it sit there for 20, 30, maybe even 40 years. So once you have all those kinds of questions, you can kind of figure out, do you want to be a trader or an investor? And the fact is, you can actually just do both. And it's what I personally do in my portfolio. And it's not as challenging as you would think. I will say For beginners to the market, to capital markets, I think it's important if you have a smaller account to just choose one or the other. And I always say it's better to choose investing first. Um, and then as you grow your account through regular deposits, just through whatever income you have, maybe allocate a certain, percentage of that to become kind of your trading portfolio. And I have that kind of diagrammed here. So we have an example portfolio here in the center, and that center portfolio is going to represent 100% of your entire portfolio. So all of the money you have in the market. And then we see that it's divided into kind of these pie slices. 90% we say is investing, and then 10% of it is trading. And then we can differentiate those two portfolios into kind of their own sub portfolio. So we'll start on the left, the trading portfolio, and we can see here that we have 70% of that 10% of our entire portfolio as stocks, and then 25% is alternatives. And when I say alternatives, I typically mean options. And then we have 5% cash, and we have the cash there in case there's any unexpected opportunities that we can throw some money into. And then on the right side, we have the much greater slice of the pie, the 90% investing. And within that slice of pie, we can see that it's further broken down, with 60% of it being stocks, 30% being fixed income bonds, 5% being alternatives, so options again, typically in the form of hedges. And both options and hedging is something I'll talk about later in the workshop series. But if you don't really understand what I mean by those things right now, that's fine. And then 5% cash for the same reason as we have in the trading, in case there's any unexpected opportunities, and we want to go ahead and jump on those. We have some funds available without needing to sell anything. So the next two slides are going to be a total of 10 rules. The first is 5 foundational rules of investing, and the second is, as you probably guessed, the foundational rules of trading. There's 5 of those as well. So first things first, contribute early and often when talking about investments. So with investing, you have time on your side. You have time to witness the market crash and rise and crash and rise and crash and rise again before you need to actually use that money for retirement. Again, if you have a short-term time horizon, like say, buying a house in 10 years, you may only want to see it crash and rise at least once. But contributing early and contributing often. And when I say contributing often, I mean don't just put $1,000 in there now. Think you heard the magic of compound interest and expect to have millions and millions of dollars from a S&P 500 index fund in 20 years. The best way to mitigate risk as well as amplify that compound interest is to again start early, but keep contributing to it over time, and you'll watch it grow exponentially. 2 is we have limit taxes and fees. So fees are less relevant now. A lot of the brokers last year, starting with Charles Schwab, the major ones I mean, decided to set their fees to 0, which was great. Option fees still exist, some futures contract fees still exist, and some transactional fees still exist. But for the most part, average traders just see 0 trading fees, 0 trading commissions. Taxes, however, are a huge component of your potential profit margin. So there's a difference between short-term capital gains tax and long-term capital gains tax. And I won't spend too much time talking about it, but long-term capital gains tax is significantly better for you than short-term capital gains tax. So whenever you have an investment that you buy and sell within the span of 1 year, you're subject to short-term capital gains tax. Likewise, if you have an investment that you've bought, say, on January 1st, 2020, and sold on February 1st, 2021, a year and 1 month, then you would be subject to long-term capital gains tax, which is a significantly lower rate. And then we have rule number 3, which is diversify your portfolio. This is something you'll surely hear from almost every business professor or finance professor that you have. Simply put, it is safer for you to distribute your money over a variety of assets than it is to just put it all in one asset. The saying, don't put your eggs in one basket, applies here. Then we have 4, consider your time horizon. So make sure you understand when you need this money. I know right now, considering most of us watching this are probably very young, in our 20s, surely, that we have a lot of time before retirement if that's our goal. Now, as we near retirement, say within 10 years, it may be wise to start allocating some of our portfolio into safer investments like fixed income, away from stocks, which are more volatile and subject to large drops, depending on news like the coronavirus. And then lastly, we have 5, which is focus on your long-term goals. And this simply just means if you have a investment account designed to get you to retirement, and you start walking through the mall a month later, and you're like, wow, I really want whatever this expensive item is. So you check your bank account, you don't have enough money. So you check your brokerage account, you're like, oh, I have some money in here. You sell a position and then transfer that money to your checking account so you can buy whatever it is in the mall the next day. That is not focusing on your long term goals. Make sure you keep the goal of your account consistent. Obviously, if an emergency happens, you need some funds, you have to do what you got to do. Um, but if you're investing for retirement, it's better to just consider any money you put into an investment retirement account dead to you, just gone until you need it later. And then one of the last slides I have here is the foundational rules of trading. Always have a trading plan, number one. This just means what you're looking for when you're making trades. If you're a trend trader, what kind of trends are you looking for? Do you like to trade on stocks going up? Do you like to trade on stocks going down? And then that kind of goes hand in hand with rule 2, which is protect your trading capital. So when you make this trading plan, you'll say, okay, I never want to risk more than 5% of my, or 10% of my trading portfolio in any single investment. So if I have $1,000 on any one trade, I won't go over $100 into that trade. And likewise, I may set stop losses, and that's rule number 4, and I'll get there. Stop losses that if any one trade goes against me by 10%, meaning I lose 10% of what I put in, then it will automatically get me out. And all of these kind of go hand in hand, but rule 3, only risk what you can afford to lose. So only what you can afford to lose means don't put your life savings into a very risky trading bet, because you're more likely than not to lose it. On the off chance that you get very, very lucky and multiply that life savings by thousands of percent, you're probably likely to try it again and lose the second time. But only risk what you can afford to lose, and that goes in with the stop losses. If you don't want to lose more than $100 or $50 on a trade, then make sure to set a stop loss that will get you out of that position at $49 of loss, and it'll get you out of the position. And then rule 5, we have know when to stop trading. Simply meaning, if you're losing and you're getting frustrated or you're lost, the wrong answer is to double down, which a lot of people do. Just take a break, get off the computer, stop looking at the charts, back off, reassess your trading plan, and then come back at it either the next trading day or even take a week off. People who try to recoup lost capital by doubling down on a position typically lose double their money. So keep that in mind. Keep all of these rules in mind when you're trading, especially just use a plan, have a plan. Don't go in there blind. I heard this pharmaceutical company has a 50-50 shot of getting an FDA approval. So I'm going to put 50% of my entire portfolio in it on the hopes that I'll make hundreds of thousands of dollars. You very well may, but more likely than not, you won't. So anyway, that is the presentation. Here's normally where I have the audience Q&A, but I don't. So I'm going to leave this slide up for just a second as the video ends. If you have any questions for me, again, feel free to email me at research@bowerfa.org, and I'll be happy to reach out to you with my answers. Thank you all so much for listening, and I hope to see you at the second workshop.